welcome to this special conversation between two of the world's most powerful women in finance. This week, at an IMF meet, Federal Reserve Chairperson Janet Yellen argued that monetary policy faces significant limitations as a tool to promote financial stability. She also said that while she does see pockets of increased risk-taking across the financial system, an acceleration or broadening of these concerns could necessitate a more robust macro-prudential approach, in effect saying that financial risks and bubbles are better dealt with by macro-prudential regulation and not monetary policy. Now, after that speech, she was questioned by none other than IMF chief Christine Lagarde on the global impact of zero-rate policies. Here is that very interesting conversation between Christine Lagarde and Janet Yellen.
Would you say that macro-prudential tools are second fiddle to the main Stradivarius of monetary policy? Or would you say that, depending on circumstances, macro-prudential tools become the premier violon and have to deal with the issues as a first line of defense?
Well, I think my main theme here today is that macro-prudential policy should be the main line of defense. And I think the efforts that we're engaged in the United States, but all countries coordinating through Basel, through the financial stability boards, the efforts that we are taking to globally strengthen the resilience of the financial system, more capital, higher quality capital, higher liquidity buffers, stronger and arrangements for central clearing of derivatives that reduce interconnectedness among systemically important financial institutions, strengthening of the architecture of the payments and clearing system, dealing with risks we see in areas like tri-party repo, all of these efforts, and particularly focusing on the resilience of the most systemically important firms through SIFI surcharges and other measures, higher leverage ratios. I see this as the core step that we need to take in the United States and globally to create a safer and sounder financial system. And if we're able to do that, reducing also the reliance on wholesale funding, if the system does experience shocks, it will be better able to deal with it. I would also put resolution planning, which we're engaging in actively, is among those measures. And, as I mentioned, I think cyclical policies and sector-specific policies that we're seeing many emerging markets take, steps that can be used particularly when we see problems developing in housing or a particular sector. These are really promising. I don't think we yet understand how they work, when they can be effective, how we should use them. I hope this will be an area for the IMF and for us of active research so we can better deploy those tools, counter-cyclical capital charges. But I think importantly, I've not taken monetary policy totally off the table as a measure to be used when financial excesses are developing, because I think we have to recognize that macro-prudential tools have their limitations. Right. And there may be times when monetary policy doesn't need to be adjusted or deployed or to lean against the wind. So to me, it's not a first line of defense, but it is something that has to be actively in the mix.
Right. And if you're using your first line of defense, do you think that this is likely, not now, but sort of in more calm, possibly, and in more medium-term times, would that help us get away from this zero lower bound environment in which monetary policy is currently a bit stuck, without being negative about the being stuck? words that I'm using, but whether it's here or whether it is in the UK or in the euro area, we are faced with that issue, with the exploring of negative interest rates, as is the case now by the ECB. Do you believe that the sort of constant use of those macroprudential tools are likely to move us out of that direction?
So it is remarkable to see how many countries have been affected by the zero lower bound. It's something that for most of my career would have seemed frankly unimaginable. And often it has been the case that these episodes have occurred in the aftermath of a crisis that impacted the financial system, whether it's in Japan or here in the United States. True. So, I think it will be helpful if we can strengthen the financial system. Such huge adverse shocks are less likely. Still, it is a real possibility. And for example, the work that we've done with the standard kind of macroeconomic models we use inside the Federal Reserve, looking at the incidence of shocks that have occurred, there is a real possibility, there remains a real possibility that we could continue to be hit by the zero lower bound. And I think, we've had recently many discussions of secular stagnation, or the notion that for some period of time, whether it's because of slower productivity growth or headwinds from the financial crisis or demographic trends, that so-called equilibrium real interest rates may be at a lower level than we've seen historically. And that's one of the factors that I think will be important in determining how frequently a negative shock could push economies against the zero lower bound. So if it is correct that equilibrium real rates in the United States and globally may be lower going forward than they have been historically, I think we will have to worry about these episodes more often. And of course, often there are other tools besides monetary policy, and sometimes monetary policy bears the brunt. I mean, in recent years, it has borne the brunt of responding. I think if countries had greater fiscal scope, if they had more room for the use of fiscal policy than many countries have now, there would be a larger toolkit that could be used to respond to the zero lower bound.
Right. Well, the toolkit at the moment seems to include more structural reforms than fiscal space, although the situation is improving slightly. On the sort of tendential lower interest rates, our research department that is headed by Olivier Blanchard, who is around somewhere, has done similar work to the one that you're alluding to, and we point to that direction as well.
So that's
one. Let me take you one circle further. You've beautifully demonstrated the efforts that have been undertaken from a macroprudential point of view in terms of the universe that you have under your jurisdiction. But this universe, being restricted and well supervised as it is, has generated the creation of parallel universes. And, I'm just thinking of you, Janet, with the toolbox, with all the attributes that you have. What can you do about the shadow banking at large? And, I'm not giving it any dismissive connotations. It just happens that there have been development of alternative funding mechanisms and financing mechanisms that are outside the realm of central bankers. What can be done about them in order to make sure that there is no creation of significant risk threats out there which are not covered by macroprudential tools?
So I think you're pointing to something that is an enormous challenge. And we simply have to expect that when we draw regulatory boundaries and supervise intensely within them, that there is the prospect that activities will move outside those boundaries, and we won't be able to detect them. And if we can, we won't have adequate regulatory tools. And that is going to be a huge challenge to which I don't have a great answer. But as we think about tools that we can use to address systemic risk, I think it's particularly useful to focus on those that have the potential to control risks, not only among regulated institutions, but also more broadly. And that's one reason that in the speech I gave, I mentioned margin requirements, and that can serve to limit leverage not only within the banking system, but more broadly by any institution, a hedge fund or an unregulated, right, that would be borrowing, using short-term financing to take on leverage positions. Because this is the type of tool that might have wide, more universal effect. I'd say also, we have developed as many, as you have, and as many central banks have, very active monitoring programs to try to be on the lookout for what will cause the next crisis. Hopefully many, many years in the future, but
we'll both be retired by then.
I think, I certainly hope so. But what are the new threats? And we're trying to look for those and to be attentive to them, and particularly to look outside the regulatory perimeter to see where threats are emerging. But this is a real challenge, I think, for all of us.